Now, Jerome Powell just came out and he gave an 8-minute long speech, and needless to say, the markets really didn't like it. Markets were open when he started talking, and actually they were almost entirely flat for that trading period. But after he finished, the S&P 500 had fallen by 3.4%. The Nasdaq had fallen by 4%, and some of the more volatile stocks like Coinbase was down 6.5%, and the ARK-K ETF fund was down by 7%. All simply because they didn't like what he had to say. So today with this video, we're just going to quickly establish what exactly he said and why the markets panicked so much.
The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. The U.S. economy is clearly slowing from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. While the latest economic data have been mixed, in my view, our economy continues to show strong underlying momentum. The labor market is particularly strong, but it is clearly out of balance, with demand for workers substantially exceeding the supply of available workers. Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. So, we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is in the Summary of Economic Projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, estimates of longer run neutral are not a place to pause or stop. July's increase in the target range was the second 75 basis point increase in as many meetings, and I said then that another unusually large increase could be appropriate at our next meeting. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. Our monetary policy deliberations and decisions build on what we've learned about inflation dynamics, both from the high and volatile inflation of the 1970s and 1980s, and from the low and stable inflation of the last quarter century. And in particular, we're drawing on three important lessons that I'll highlight. The first lesson is that central banks can and should take responsibility for delivering low and stable inflation. It may seem strange now that central bankers and others once needed convincing on these two fronts. But as former Chairman Ben Bernanke has shown, both propositions were widely questioned during the Great Inflation period. Today, we regard these questions as settled. Our responsibility to deliver price stability is unconditional. And that brings me to the third lesson, which is that we must keep at it until the job is done. History shows that the employment costs of bringing down inflation are likely to increase with delay, as high inflation becomes more entrenched in wage and price setting. The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem high inflation and to start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. So, these lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done. Thank you.
So there are some important things to note with that speech right off the bat. Now, he started off emphasizing how important it is to kill inflation and to kill it properly. He mentioned that when it got entrenched, like we saw in the 1970s, that it got so much more painful to kill inflation then, and he really doesn't want that same situation happening here today. He also mentioned a bunch of other things, like how inflation hits the poorest in society the hardest, and that is categorically correct. He also mentioned how in the past there was sort of a debate about whether or not central banks and the Federal Reserve in particular could or even should try to influence inflation. But that is no longer the case. It is now entirely clear that the Fed can influence inflation and that also it should. Basically, he was justifying his future actions, saying that I know what I'm about to do. These rate hikes, they're going to hurt, they're going to damage the economy. But trust me, not hiking these rates will be so much worse in the long run. He then goes on to talk about the current situation with the American economy, and he's pretty clear. He thinks that actually the American economy is rather strong right now and the labor market is still particularly strong. Now, that is usually a really good thing, but when inflation is nigh on 9%, that's a really bad thing. He wants to see it all get bad. He wants to see unemployment rise and for people to lose their jobs, not get their jobs, because that would help to bring down inflation. This also ties in with that whole idea of the recession not really being real yet, which again would usually be a good thing if there wasn't a recession. Powell might be hinting that actually he slightly agrees with the White House, not necessarily over the definition of a recession, but that the idea that the economy is in a recession now maybe isn't entirely solid because of how strong certain things like the labor market are. This here isn't really good news and Powell knows it well. Then Powell talks about the task at hand and he makes it clear that things are going to get worse in the future. This isn't the end of the rate hiking cycle. 1 month of a good inflation reading is not enough. And to quote him, he literally said it falls far short of what they need to see before they start changing what they're doing. Of course, July's American CPI data was 0% of inflation month over month, and loads of people got super bullish on this. They thought that inflation is over, that the bear market is over, and that Powell will change his mind and interest rates will be cut instead of hiked, and so it'll be happy days. Powell shot those ideas down and he did it very firmly. He killed them as dead as they can be. 1 month is not even close to being enough to make a trend. Powell then took aim at another problem. People think that the Fed's aim is to lightly tackle inflation without causing a recession, and while that would be ideal if this were the case, when inflation would start to fall, then Powell would slowly ease his foot off the gas. He would be lighter, he would probably stop raising rates at all and let the previous rate hikes do their job. Once again, he shot down at these ideas, he killed them dead. He specifically said that until inflation is at the 2% mark that they're aiming for, his foot will stay on the gas. This is because there's nothing more destructive than starting to tackle inflation and then losing your nerve and allowing it to rise again, only to have to start from square one all over again. He seems to be pretty adamant that he will not make that mistake. Now, he also mentioned how most investors and the market as a whole is sort of pricing in a terminal federal funds rate, which is basically just the final highest interest rate that the Federal Reserve hikes to, as neutral or about 2.5% or where we are today. He again shot that idea down and said no, the interest rates are not going to stop going up here, they're going to keep going higher. He basically came out and for 10 minutes told every investor on YouTube that they're wrong and they've been wrong over the entirety of the last month. It is not over. The situation is not going to stop here. We're only getting started. Now, the real problem with this and why the markets reacted so negatively to this is because for the entire last 2 months, we've seen a massive bear market rally based on this idea that the Federal Reserve would pivot and stop their rate hikes. There's a bit more to it than that as well. It was also pricing in this idea that inflation is waning and that the economy is going to be in this magic Goldilocks zone where it's not too strong that inflation continues to rise, but it's also not so bad that we see a catastrophic recession. Powell basically came out and told everyone who was propagating this rally that they're wrong and stupid and this market movement was irrational. He will not pivot until the job is done, until inflation has fallen to 2%. In my opinion, that means a minimum of another 6 months or so of rate hikes to above 4% interest rates, and then he will maintain those high interest rates of that level for at least another year on top of that. Only then can we actually expect the Fed to start to ease off the gas. Frankly, that means 2024 or so of tough market conditions, of a tough capital environment, of businesses struggling to grow and people living paycheck to paycheck. This speech just affirmed everything I've been saying for months now, that the markets are still too bullish, that YouTube investors are still too bullish. This is going to be a long and slow bear market, and it's not going to stop anytime soon. If there were one phrase that encapsulates what we just saw, it would be beatings will continue until morale improves. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Thank you all for watching. Stay stoic. Until next time.